Good afternoon, everyone. Rich Swerbinski, President and COO of the Mortgage Collaborative, here once again with the last week in Mortgage Today. Each week I am joined by one of our lender members in the co-host seat. And once again in that seat this week, the President and CEO of Megastar Financial Corp, Anita Padilla Fitzgerald. Anita, thanks for joining me.
Thanks for having me.
All right. So at the outset here, just want to remind everyone, strive for an interactive program here. Any questions, comments, thoughts, anything you want to add, please feel free to drop it in the chat or the Q&A, and we will voice it aloud and incorporate it. So Anita, we always spend the first part of this show kind of going through the news headlines, and so much in the news right now in the mortgage lending industry. We obviously got a new presidential administration, a new CFPB. We've got talk of government-run credit reports, potential of some sort of first-time homebuyer tax credit that's kind of being bandied about, Super Bowl commercials featuring mortgage companies. What's top of mind to you from amongst those news headlines right now as a business owner?
Thank you, Rich. I'll start in kind of that order, starting with the CFPB and the assignment of Mr. Chopra. My opinion is I was relieved that under the Trump administration, they didn't implement or remove the skin in the game law. I thought that was going to be detrimental to our market with regard to expanding credit so large that it would again falsely increase real estate values. So the new administration, from what I can see under the new director, focus on student loans. I think that's important. And I think payday lending and bank fees. We've all read the headlines with regard to a lot of the situations with bank fees not being properly managed. But fintech is something I think about. So we really need to think about these fintech companies and how that's going to affect our business and what kind of regulation is going to go around that. So if you think about some of these companies, bank versus the fintech companies, as an example, mortgage companies, and what we have traditionally had as our landscape. So people might put money on deposit with one of these fintech companies who are paying higher than a bank, but then you have to say, well, who's going to give you a loan? Who's going to support the community? Who's going to help new businesses get started? And, from our perspective, same thing with regard to mortgage lending and being able to be advocates for consumers. So overall, my thing on the CFPB is I think, Warren is tough, but we already went through that game back in 2008, and I just don't see much change for us in the mortgage industry. I do think, again, them cracking down and maybe putting some rules around fintech can only help our industry. But I think we've been kind of the good kids on the block throughout the year, supporting many Americans in obtaining low fixed rate financing. So I don't think that their focus is going to be so much on us. I think they have bigger fish to fry.
What about, like my belief, like mortgage companies made a lot of money last year. Now a lot of these companies are public, right? So it's out there publicly. No fear that, the combination of so much of the mortgage pie going to lesser regulated independent mortgage companies combined with the, the profit of some of these companies, that's not, the temptation will not be, of the CFPB to start to, really nose around under the hood a little bit more?
I think if they do, I think there's two sides to that street, right? So nosing around with regard to how that's going to affect the fintech companies versus how that's going to affect the traditional mortgage bankers. So when we look at the rules that we have in place, the rules are actually in our favor is IMBs because we're good at what we do. We're good at providing customer service. We're good at taking care of our customers. But when you have companies running Super Bowl commercials who are telling people that you can get a mortgage approved while you're getting a cup of coffee, we all know that's not really true, but the consumer doesn't really know that. So some of those things could potentially play in our favor. They're not going to tell you that the finding that they're using, that the data maybe was or wasn't validated, and that it doesn't apply to every agency with the exception of Fannie Mae, and that it doesn't apply to people who work for employers who don't participate in the digital validation, et cetera, et cetera. So I do think there'll be some nosing around in that. I just don't believe that as an independent mortgage banker that it's going to be harmful necessarily to our business.
This is the last week in Mortgage Today. I am joined by Megastar Financial CEO, Anita Padilla Fitzgerald, a Megastar independent mortgage banking company based out of Denver, Colorado. Anita, over $2 billion in production last year, if I remember correctly?
Close to 3.
Almost 3. Wow, congratulations. So that's awesome. What about government-run credit reports? So I was talking with Rob Krisman about this a little bit last Friday, and Tracy King Donadio from Partners Credit. And, this was in the Biden housing plan, the potential, based on their belief that, the black box of credit scores and their desire to create a level playing field, for all potential home buyers, the possibility of the government through the CFPB kind of taking over credit reporting and credit scores. Any reaction to that?
Yeah. So, and thank you for asking. As a girl who kind of grew up in that community, a minority, growing up in a poor community, born into a family who didn't have a lot. And it's really an economic issue, in my opinion, more so than a minority issue. So it wasn't long ago that Black people were brought over as slaves. And then there's a lot of people who are born into economic environments whereby their parents don't have checking accounts. They don't have savings accounts. So they are exposed to what they're exposed to. So maybe their first opportunity at a credit card is at Walmart. It's not American Express. And they don't have the traditional credit structures around them that are available to them to establish credits. So if you think about the FICO score, and I was around, and I'm sure a lot of folks on the phone today were around when the credit score was initially introduced, and you thought to yourself, well, what is this number? But if you think about how that black box works, it really is conducive to people who have that ability based on their environment to build those type of credit histories to build the score. So there are other people who are paying their utility bills on time, who are paying other type situations and utilities on time, and they are credit worthy and establishing. So I think the issue really is, the way I've read it, is the traditional model isn't considering a lot of folks that didn't have the ability to build the credit the way the FICO score was built. Now, I get the issue with, the government being in charge and what have you, but, there's if you look at the credit bureaus, they haven't been, 100% perfect either. I don't like as an IMB that they're selling, when we pull a credit report, they turn around and sell it to other mortgage companies. I don't like that. So I think there are challenges out there. So is it going to be a utility? Will it continue to move forward? Once again, I understand people's concern about the government taking over, but I also feel that there are a lot of Americans who haven't been privileged to really be able to establish those traditional credit trends. And I think it could open our market up to be able to assist more people.
Thanks, Anita. And again, any questions, comments, thoughts anybody has, please feel free to drop them in the chat or the Q&A. We can voice them aloud. And Anita, the next thing I want to get your thoughts on, I got to admit, I am now really openly starting to get concerned about home values, the run up that we've seen recently, the history on increases in home values, like what we're seeing now and what has followed that, and the potential of a bubble. So, if you look at just the home value appreciation statistics, it's obvious, just big gains year after year. We have an inventory problem in America that I don't see any signs of it going away anytime soon. Now, we've got the Federal Reserve with their foot firmly on the mortgage bond market gas pedal, driving hard to buy that market to keep mortgage rates low. We're talking about the potential of a first-time homebuyer tax credit that could have some unforeseen negative implications. And we're talking about opening more access to credit, more loans, more buyers, not enough housing stock, a lot of impediments to the home building side of our industry, if it's workers or lots or the cost of key materials. Is that something you worry about as the owner of an independent mortgage banking company?
Well, what is a traditional land, labor, and lumber, right? So, and cost to build, and I'll start by saying, I get that the tax credit is going to help people with the ability to purchase homes and bring more competition into the market that's maybe not there today. Investors trying to buy property and there's already low inventory, and what's that going to do? As far as, I don't know the answer. I think that communities will continue to expand. I drove from Denver to Fort Collins this morning and I haven't driven this way in a while, and really taken back about, how much development is going on and building and all of those things. And then you run into infrastructure, and how are these communities going to be able to manage that if they don't have the proper transportation and trains and that type of thing, because it can't all be highway. What's going to go on there? But I'm pro on the tax credit. And as far as the bubble is concerned, Rich, I don't know. I do feel that, again, we've been kind of the good kids on the street since the 2008 crash. I think the credit box makes sense. Even if real estate values do go down, it won't, I don't believe, be as drastic as it was in 2008. There will be some adjustment, but I think that values could fall some. I don't think it's going to be anything devastating, and we'll just keep marching forward.
With Anita Padilla Fitzgerald, CEO of Megastar Financial Corp out of Denver, Colorado. And Anita, you touched on it a little bit earlier. United Wholesale, Rocket, Loan Depot recently went public. These big giant mortgage companies that are raising lots of money to scale their business. I'm always curious just to get the perspective of a business owner that owns a medium, large size company, like how you view that. Do you view that as like, yay for the IMB, or I worry about, their ability to scale and adopt technology and the impact on a company like yours? How do you look at that dynamic that's happening right now?
Well, I break IMBs down very much into two categories. There are the direct-to-consumer, like Quicken, and then aggregators, Loan Depot, etc. And then there are the traditional mortgage bankers, as I consider myself. And if you go to any of their websites, you go to Loan Depot's website as an example, and you look at their postings of who they're hiring, the majority of people they're hiring are developers. Not closers, not underwriters, not processors. They are hiring developers because they're building their technologies and they're embracing artificial intelligence. And one of the things that I feel that I've seen in our market is not enough independent mortgage banker CEOs are really embracing the AI specifically, and just starting with, forget about everything else. Let's just focus on what the agencies have been providing us for decades. It's called DU and LP, right? So we got to get our traditional loan officers to break the habit of the back of the business card and to use the digital validations that are afforded to us. And when you use those digital validations, you're going to reduce your cost to produce substantially. So you're able to get your loan done. And really, to Quicken's point, If you get an income validation, and if your people know how to correctly complete the 1003 so that you do get a hit on your validation, a lot of times you don't need assets. Sometimes you get a property inspection waiver. And many times you get a CU, you get an appraisal with a CU score of 2.5 or lower, which means you don't even need an underwriter to underwrite that appraisal. You can use a check sheet. Flood insurance, boom, boom, boom. So you can train an FTE to do that at a much lower cost to produce. You streamline your business and you don't need an underwriter, and you're much faster. So that's exactly what Quicken's doing. That's what loanDepot's doing. And they're doing it in terms of maybe some robotics. But I say to you, why would you want a robot up front doing some of these tasks for you when you haven't even embraced the DU and LP? Because that's something that we really need to focus on as an industry, and figuring out how to get your team, your loan officers, and then monetizing your database. So you have your traditional loan officers and they bring in the business. So we pay those loan officers to be advocates for our business. Great. Quicken uses the money to run their Super Bowl commercial. So if you take that professional advocate who knows the business, who embraces the artificial intelligence, once again, DU and LP, you're going to be able to really streamline your business, because you're going to need that to compete. So, and then from monetizing your database, right? You probably all have loan officers like we do who were here, who left, but you originated that loan. And for many of you, you're servicing that loan. So that's your customer. Are you staying front of mind? Are you flowing to that client and making sure that client knows, hey, Susie loan officer may be working at XYZ mortgage company, but we're still here too. We'd love to give you a quote. And then if you take young mortgage bankers and their license and you teach them the business just like Quicken did, you can run that market without the commission, and then you can be more competitive in your price, or you can increase your margin. So when I see Quicken and I see loanDepot, you know, they are using digital technology and artificial intelligence because it is their goal to replace the traditional loan officer. So that's really how I see it, not as much as an IMB play, because we're good at what we do, and I feel that we'll always be better than banks. With the exception of banks who truly carve out their mortgage companies. We do compete with them. But overall, most banks, they will run, you know, mortgage is kind of like the stepchild within the organization. So our competition, in my opinion, firmly, are the companies that are going consumer direct and really using digital to do so.
Fascinating perspective. Yeah, I really appreciate your thoughts on that. And want to turn my attention to, how do you view Zillow? You know, like I've heard members of ours that I've talked to talk about, you know, their fear of losing a customer before you know you've lost them, right? Megastar, you've got a great sales team, personal touch, advantages that you just laid out versus these companies that want to replace humans with robots and AI. But you know, what about, you know, Joe homebuyer that, you know, has done a loan or their last couple of loans with Megastar that's, you know, browsing on Zillow for a new home, and, you know, they're, I think, getting increasingly good, and they're kind of dovish about their plans in the mortgage area, but I think it's clear they're digging their feet in more, where they, you know, it becomes very quick and easy, and with some sort of benefit to buying the home to apply right there on Zillow. Is that something that you see, you know, as a competitive threat in the future?
I do. So here's what Zillow's done, in my opinion, is they've been very good about being front of mind, right? They're always advertising, and then they monetize their database. They take that database and they say, okay, gotcha. I got your name. Now I'm going to keep in front of you, front of you, front of you, front of you. So front of mind, front of mind, front of mind. They've done that well. You know, they've developed their site to the Saturday Night Live commercial, right? So that's like people's favorite pastime. I'm going to go play on Zillow. And how exciting is this? I'm personally a realtor.com fan, and I do use realtor.com. To talk about real estate appreciating in the United States, well, not New York City. So I'm looking at New York City. I'm looking at it every day because those prices keep dropping. Well, I know New York's going to come back. So if you can find a building you think is going to make it through this, when people's ability to continue to make their payments, maybe it's a good investment. But Zillow is keeping front of mind. So for me, I'm like, thank you, because what Zillow's going to do is they're going to capture that client. But if I'm also staying front of mind, I am using my database, and every single person that talks to a loan officer at Megastar is automatically loaded into my CRM. And then I am staying in flow with those people on a consistent basis. It's like, let's do it, right? So most people, they're going to go to Zillow. Maybe they'll have a good experience or not. And then they turn around, they get another from Megastar. Hey, well, we're always here. We'd love to do business with you. Maybe we give you a price quote. So it's good to shop. Now, if I use my digital, I'm going to be better than they are, and I'm going to have an advocate. So, but if you're not monetizing your database and you are not staying front of mind with your clients, I would absolutely be threatened. But I'm not threatened because I am using digital, and I will provide better service. And when I get that type of situation in my system and I don't have to hand it off to a fully paid retail loan officer, maybe I can keep that client because I still have a lot of margin built in. So by the same token, I need to support the loan officers that work at my company because they are our bread and butter, but we keep them front of mind too. And then they can compete for a loan if they need to compete for a loan and win it that way. But that's kind of how I look at Zillow. Now, Zillow also offers all these other, we'll buy your home, we'll list your home, we'll give you a mortgage, we'll do all of these things. But if you're good at what you do and you can compete, then, we can thank Zillow for spending all the marketing dollars that they do to stay in front of clients.
This is the last week in mortgage today. I've got about 7-8 minutes left with Megastar Financial CEO Anita Padilla Fitzgerald. And if anybody has not seen the Zillow Saturday Night Live skit, Google it or YouTube it immediately, because it was hysterical. So, but Anita, I want to turn our attention to the just competitive climate in general. I've talked about it before. I believe this could be, and into next year as well, the biggest years of M&A maybe we've ever seen in the residential mortgage industry. Certainly a lot of mortgage companies have made a lot of money. A lot of mortgage companies have older ownership. Just in talking to people anecdotally, it feels like there is some sense of the going to ride out this refi wave, and no shortage of large national companies that are looking to scale and add to kind of a distributed retail network. How do you view the competitive landscape right now in general? And do you agree with my assessment about the potential of really heightened merger and acquisition activity these next couple of years?
Yeah, I see. I agree with you. I think that we will see companies selling, merging, what have you, as owner, and I'm sure with everybody out in our audience today, we all know how much cash we need to have on our balance sheets to run our business. We made a tremendous amount of money last year, and what a nice time to just say goodbye and kind of move on to our next hurrah. I'm not there. I feel like, I love what I do. I think it's fun. Our company runs really very efficiently. I run 3 companies. So it doesn't take a lot of my time, but I think it'll be interesting. And then because we're hanging in, what I think we'll see is some of these M&As won't work out for the people they're acquiring, some of these top producers, loan officers. with top producers, they're an interesting breed. They've been around for a long time and we certainly value them, but I'm investing a lot in young mortgage bankers, young licensed mortgage bankers, and, teaching them to embrace artificial intelligence. And they won't even know what the back of the business card means, because that's not how they'll be taught. And then using technology to put your knowledge in the system, so it literally can bring a processor up to speed in no time. They just follow the rules, do this, click here, do this. Got a VA loan, you need a DD 214. Oh, don't have one, you know how to go get one, go do this, click here, go here. So I think it'll be an interesting year. I think that the IMBs that hang in, we're good at what we do, and I think we will become stronger, and I think that we will pick up some folks from some of these mergers. And big companies just keep getting big. They're good at it.
Got a few minutes left here with Anita Padilla Fitzgerald. Any questions or comments, please feel free to put them in the chat or the Q&A. Work from home, Anita, where are you at with that? Are you planning on keeping people remote exclusively? What are your plans exactly with the company, as assuming that we continue to see progress with the pandemic and the numbers?
So it's an interesting question. So as the owner of my building, part of me, I'll have employees who say, oh, well, can I work from home on Tuesdays and Thursdays? And I'd be like, well, I pay for your office on Monday, Tuesday, Wednesday, Thursday, and Friday. So we need to think about that. Netflix had originally sent this was prior to the pandemic, when Netflix CEO did a study of having people work from home, and he said it's not going to work, and he brought everybody back in the office. My feeling is there are going to be positions that can work from home. So you have kind of two factors for working from home. One is a position that's fairly administrative, that people are happy doing what they're doing, and they just do that, for the rest of their days. Then there are the professionals like processors and underwriters who can work from home. They're trained, they already know what they're doing, and they're underwriting loans, and they're happy doing that. But there's another segment where your management team, as an example, I feel you need to collaborate with those people, right? We need to get together. We need to talk. I need to come to TMC conferences. I need to sit down with you, Rich, and have a glass of wine and really talk about, because that's where growth and creativity comes from. So for our company, I'm going to allow people to work from home. Why wouldn't I? Because I don't have to pay for parking, I don't have rent, I don't have any of that situation. And as long as their job isn't one where we need to collaborate to grow the company, run the company, fix the company, whatever the situation is, and they want to work from home, that's great. They can work there for 20 years and that's just fine.
So I've got just a couple minutes left, and before we conclude things, a couple reminders of some upcoming programs in the TMC Connect network. Coming up at the top of the hour at 3 p.m. Eastern, our friends at experience.com, formerly known as Social Survey, with a session called Make Experiences Matter More. And the link to register for that, we just dropped in the chat. And then tomorrow at 2 p.m. Eastern, we're doing a session titled Trends Driving Subservicing Adoption and What You Need to Consider. A lot of things that a lot of our members are looking at as we get into 2021, and have our friends and partners at Doven Mule and Cenlar that'll be helping to lead that discussion. And you can also register for that in the chat as well. And I'm just reminded that session is not tomorrow, it's Thursday. Thank you, Ashley. So Anita, wrapping up here, in general, how you view the buying season this year? I read a column this morning saying that it's just like one long buying season. I was looking at the MBA purchase application statistics. They fell off a little in mid to late December, spiked back up right after the new year, came down a little bit, but now they're right back up. Seems like purchase activity is staying pretty strong. We had that weird purchase season last year because not a lot happened in March and April with all the uncertainty. We had that elongated like May to now purchase season. Do you see that, at least in the short term, evening out more and not following the traditional patterns of when people buy homes?
So, it's an interesting question. To your point, there's so much going on here, right? We feel like we're coming out of COVID, and what's going to happen with with our ability to get more people back to work, back in the market. You also see forbearance coming up, right? So forbearance is going to be expiring. Are people going to be able to, what's going to happen? Are they going to be able to continue to extend their forbearance? Are they going to be able to make their mortgage payments? Are they going to be, back to work? And to your point earlier with the work from home, there are folks that really have established, well, I want to work from home. I don't want to live in the city. So, my answer is I don't really know, Rich. But those are some of the factors that kind of run through my brain and wonder, what's going to happen. And I still don't think once the CARE Act's expired that we've seen what's going to happen to the economy, what's going to happen to employment, and how companies are going to bounce back, how many small businesses are going to be able to continue to move forward and keep people employed.
Thanks, Anita. We dropped a link to the Zillow Saturday Night Live skit in the chat. It is worth the watch if you haven't seen it. And one other reminder, tomorrow, I was confused, Thursday is our subservicing session. Tomorrow, we have 3 of our working groups that are meeting. We have 7 different working groups as part of TMC that are subsets of like professionals within our network. Tomorrow, 3 of them meet: our servicing professionals working group, our operational excellence working group, and our capital markets working group. If you're a TMC member and not participating in these fabulous resources for the individuals in your organizations that do those things, opportunity to interact with others across the country in the TMC network that are in the same roles. So, Anita, this was a outstanding conversation. I always enjoy so much talking about the business with you. Really appreciate the fabulous perspective on our industry.
Thank you. You too.
And we'll be back next week, same time, same place, 2 p.m. Eastern every Tuesday for the last week in Mortgage Today. Anita, thank you again. And thank you to all our attendees. And as always, we'll be releasing this on our YouTube channel and the recording via our podcast network. And thank you for joining us. Thanks. Stay warm.
Take care.
And have a great week, everyone. Take care.
Bye.